Good morning, guys. Welcome back again to my YouTube channel. Yesterday, I said I'm going to give you some insurance insights, and today I want to talk about the general overview about insurance. You'll find that insurance penetration in Africa is about 2%, and in Kenya, it's about 0.009%. The Bible says, "My people have perished because of lack of knowledge." But in this aspect, or in this platform, I would like to say that people have lost a good chunk of investment opportunities because of lack of knowledge. Because of lack of knowledge, because of some propaganda, some unscrupulous, I can say unscrupulous innuendos about insurance. And all these propagandas come from people who forfeited their contracts with the insurance company. All this comes from people who at some point in time have launched some fraudulent claims which are not acceptable, which were not settled by the insurance companies. Or some of these people might have been misinformed from inception of the policy. We call that disclosure of material facts. There are facts about when coming into an insurance contract you are not told about. We have principles that guide the insurance business. One of them being the principle of utmost good faith, whereby you as a client, you disclose all the material facts that an insurer needs to know for the insurer to put you on cover. And the person who is advising you, your financial advisor, should also disclose all the material facts that you need to know before coming into or entering into a contract. Understood? So I'm going to take you through some of the reasons why insurance companies don't pay claims, or some of the reasons why clients come up to launch claims prematurely, or which such kind of claims are denied by the insurance companies. An insurance policy is a contract. This is a contract where you enter, you and the company. An insurance contract is a legal contract, right? It's a legal contract that is bound by the law. Insurance companies are financial institutions, just like banks, but these two institutions are regulated differently by different bodies. For example, banks are regulated by the CBK. Insurance companies are regulated by IRA, which means there are rules or there are laws that govern these institutions. I'm going to talk about some of the few fraudulent claims in general insurance, then I'll touch a few fraudulent claims in life insurance that makes it very difficult that makes it very difficult for a person to be paid. I've mentioned of two bodies, CBK and IRA. These two bodies have different organs that assist them function efficiently. One of them being the crime prevention unit or fraud prevention units. In insurance, the fraud prevention units includes the loss adjusters, loss assessors, and many other units that are attached to it. So when a claim is launched in an insurance company, this is what happens. I'm going to give an example of a motor accident claim. The first steps is you are told by the insurer, do not accept liability. That is right. In case of any claim, do not accept liability. Report the claim to the police, where you write a report, you get an abstract, then an insurance company sends what we call a loss assessor. A loss assessor assesses the extent of the loss. He assesses whether you are on the blame or on a no blame. I will explain that. When you are on a no blame, it means you are not to blame for that accident. Another vehicle insured by another company or the same company is to be blamed. And when a situation like that arises, we have another principle called the principle of contribution, whereby as a company, we will pay you the claim, then engage the other company that was to blame to contribute towards settlement or towards what we had already settled. Then when you are to blame in an accident, it means you have to pay an excess fee. So the company has at its own discretion can decide to either settle you or not settle you, or settle you in ex gratia. That is one way of insurance companies settling claims. We have to assess the loss and determine the nature of the loss of the accident. Secondly, there are individuals who launch fraudulent claims. A guy buys a car, uses it for about 2 to 3 years and says, now I don't need this car anymore. So what should I do? I want since I have a comprehensive cover, I want the insurance company to give me another vehicle. So how do they go about it? Because insurance companies are not charitable organizations. So this guy, I don't know how they do it. They are organized for an accident. They ensure that they come out alive, but the vehicle is totally damaged. So that is an organized crime. That's a fraud. Then they launch a claim. Our assessors go. If they are not very careful, they are lured into believing that that was a real accident, because they have gone and the owner of that vehicle has gone to some of the rogue officers and they've written some abstracts that shows that this was an accident and it surely happened. So if a company is not very careful, it ends up being a claim that was staged, managed. A claim that was staged, managed. In life insurance claims, we have 2 types of claims, because some of the products in life insurance are either long-term or short-term. And these are investment products, these are education plans, these are funeral covers, these are personal accident covers. So how do these people defraud companies? Some of them fake their own deaths and provide even death certificates. And if a company is not very careful, it ends up paying that. It ends up paying that the beneficiaries, because in such cases we pay beneficiaries. So in life insurance, we have maturity claims, partial maturity claims, total and permanent disability claims, partial disability claims, critical illness claims, yeah. Now, when you as a client want to enter into an insurance contract, get all the material facts. In all the insurance companies that I know that do life insurance, can only allow accessibility of the client's funds in a span of 36 months, before which you are not paid, you cannot access your funds. But after that 6 months, we say that policy has attained what we call a cash surrender value, where you can surrender the policy and or convert it into a paid up, and you're given your money. But administration fees will be deducted. Remember, this is a binding contract. If you enter into a contract today, pay your first premium as your savings, and in 2 or 3 months, or even the next 3 weeks or 4 weeks, you get into an accident or you become critically ill, remember, the insurance company is going to give you part of the guaranteed amount. If it's an education plan, the insurance company is going to waive the future premiums and pay the benefits when they are due. So a client transfers all his risks, all his fears to the insurance company, and the insurance, upon payment of a certain amount called premium, agrees to engage into that contract, agrees to take all those risks. So if a client contributes for example, for 6 months and say, I need my money back, it will become very difficult, because that's a breach of contract. So when people are misinformed, that's when they lose their money. A financial advisor, a financial consultant, should be able to advise his or her client in a way that this client agrees on the terms and conditions of that contract. Insurance companies are not banks where you can even withdraw your money overnight. Insurance companies are companies that have very strict regulations. For example, your financial consultant has told you, first we identify the need. What is your need? Then we realize your need is to develop a piece of land that you bought somewhere, or your need is to go for a holiday at a certain stage in time, or your need is to build your dream house, or your need is to accumulate funds to enable you take your children to good schools that you desire, that you so desire. So what do? We help you plan on the same. For example, if you want to spend 2 million on the education of your kid, It doesn't need you to go to the bank to ask for a loan to do that. You don't need to use all your savings to do that. So we help you plan. We tell you, if you save this a certain amount every month for a certain period, you will be able to achieve that. If you need this money to take care of your child's education needs in junior secondary 1, we plan for that. Junior secondary 2, 3, 4, then college or university or any tertiary institutions, we help you plan for that. So another question is, why should I save with an insurance company? You can go open a jumbo junior account in any bank and make my savings. The answer is, saving with insurance is one of the disciplined ways of doing savings. One, because you cannot just come and once you have laid down your plans, we ensure that you achieve your plans. You cannot come anytime and say I need a certain amount of money, because if insurance companies gave out money like the way banks allow you to withdraw funds, then at the end of the day you are not achieving your objectives, you are not achieving your goals. So we have regulations that help you achieve your objectives. So saving with insurance company is one of the disciplined ways of doing savings. Apart from that discipline, there's that life component that banks don't give you. We assure you, if your plans were to educate your children to a certain level and we had guaranteed you a certain amount, we have to achieve that, whether you are there or not. That's why I'm telling you, this is a legal and binding contract. Legal and binding contract. So insurance companies have optional benefits. We call them riders. Like I said before, we have a permanent total disability cover, we have a medical reimbursement rider, accidental death rider, natural death rider, critical illnesses. You know, all the critical illnesses that can siphon your money from the account until you go to a negative. So we help. The main objective of an insurance company is not to make profit. We are not a profit-making organization. But at the end of the day, we have to invest your money so that you can get something out of it. We don't call them interest. We call them bonuses. We have two types of bonuses that are declared every year. We have terminal bonuses, we have reversionary bonuses. In my next episode, I'm going to explain more about that. In my next episode, I'm going to talk about financial planning. How you can plan that little salary of yours and you remain comfortable while saving. So guys, do not be lured. Do not listen to those people who tell you insurance companies don't. We pay claims. If a person tells you that insurance companies don't pay claims, ask that person two questions. How long have you saved with the insurance company? Do you have a policy document? Because you must have a policy document. A policy document is a legal document that shows you're into contract with a certain insurance company. Another question: what was the nature of your claim? If this person answers you those three questions, then you can be able to determine the truth. Right? So guys, insurance is the best. If you want to invest with insurance. It's through investing in insurance where you can purchase properties without going for a loan. It's like planting a seed. You open up soil, you put into it a seed, then you give it time to grow. The seed germinates, it grows gradually until it matures and produces fruits and more seeds. So there is power in saving. Ladies and gentlemen, there is power in saving. If you want peace of mind, invest in insurance. If you want to grow your business portfolio, invest in insurance. You don't need to go for a loan for you to be able to expand your finances. Of course, loans are good, but if the emergency loans. There's a friend of mine who told me that do not take a loan to start a business. Do not take a loan to start a business, because these startup businesses are bound to fail. You have to fail for you to realize your mistakes. Then you wake up again after realizing your mistakes and try again. So if you take a loan, these people give you a time frame to start paying their loan, and maybe at that time the business has not yet peaked. It has not yet started giving you returns. What happens? You start sourcing for money from other areas to service your loan. At the end of the day, the business goes under. Accumulate funds and study the kind of business you're going into. Know your business, know your market before engaging in any business. Start little. Do not take $1 million from a bank and go and pump it into a business. Of course, when the business has grown at some level where you are able to determine that this business at the end of the month, this is what it gives me as returns. After removing all the expenses, paying salaries, paying myself, because you have to pay yourself, this is the profit I get. So you have known your business. So if you want to expand your business, you can take a loan, because you already know how your business runs, how your business works. That was just an insight. I don't want to go. This is my first episode. I don't want to go into details, but on my next episode, I'm going to take you through financial planning. I'm going to take you through financial planning, where I will show you how you're going to accumulate wealth through insurance companies. Stay tuned. Click that bell down there. That will allow you get notifications when I post another episode. Subscribe. If you want to support my what do I call it? If you want to support my work or what I'm doing, subscribe, like, share. So let's meet on the next episode, where I'm going to talk about financial planning. We are starting, guys, and I'm sure we are going to go far. I'm going to talk about a huge chunk of areas that you need to know when it comes to matters finance. I'm going to talk about the business of accounting. For those who are leaders, I'm going to talk about growing a successful team. I'm going to talk about market expansion, and I'm going to also give you insights about on how you're going to grow your business. For guys in public service or any employment that has pension, that pension will not be enough. 90% of retirees die early because of what? They cannot sustain the lifestyles that they were in after retirement, because that pension is very small. It's meager. We say meager. It's a meager fund that cannot sustain your lifestyle. So that's why there's power in investing in a long-term investment, where you accumulate funds that can help you after even you have retired. You can be able to open up a big business that can create an extra income for you. Those in businesses, you have to create your own pension scheme, and that pension scheme can be in a form of accumulating funds and expanding your businesses. So guys, we will talk more during my next episode. Stay tuned. Love you guys.